Stop scrolling. If you have $1,000 in your bank account right now, you're standing at a crossroads. You could blow it on a new phone and have $0 tomorrow. Or you could turn it into a wealth-building machine that pays you for the rest of your life. Most people think $1,000 isn't enough to start, but they're wrong. That first $1,000 is your seed. In this video, I'm giving you the exact 4-step blueprint to invest it like the pros. We're cutting through the noise and getting straight to the tactics. But before we flip that switch, hit subscribe and join the family. Let's turn that grand into a legacy. Ready? Let's dive in. Alright, so you've got $1,000 sitting in your bank account. First of all, congratulations. Seriously. In a world where everything is getting more expensive, saving your first $1,000 is a huge win. But now, you're probably wondering, what's next? Do you throw it all into the stock market, buy the latest crypto coin everyone's tweeting about, or just let it sit there and lose value to inflation? Look, I get it. The world of investing can feel like a maze. But today, we're doing things differently. We're not just talking about investing. We're talking about building a roadmap that actually works for the long haul. In this first part of our series, we're going to cover the boring stuff that actually makes you rich. We're laying the foundation, because if you build a house on sand, it's going to fall no matter how expensive the bricks are. Before we even look at a stock chart, we have to talk about the safety net. You might know it as an emergency fund. I know. You want to see your money grow, not just sit in a savings account. But here's the reality. Life happens. Your car breaks down, your laptop dies, or you have an unexpected medical bill. If all your money is tied up in the market and the market is down that day, you're forced to sell at a loss just to pay your bills. That is the fastest way to stay broke. Most experts say you need 3 to 6 months of expenses. But since we're starting with $1,000, let's keep it simple. If you don't have at least a small cushion yet, maybe a portion of this $1,000 stays in a high-yield savings account. It's not about the interest you're making there. It's about the peace of mind it gives you. It's your sleep well at night fund. When you have an emergency fund, you stop making desperate financial decisions. Next up, we have to be honest about debt. If you have credit card debt at a 20% or 25% interest rate, and you're trying to find an investment that pays you 8 or 10%, you're actually losing money. Think about it this way, paying off a credit card with a 20% interest rate is the exact same thing as getting an guaranteed 20% return on your money. You won't find that kind of guarantee anywhere else in the world, not in stocks, not in real estate, nowhere. So, before we move that $1,000 into a brokerage account, look at your high-interest debt. If you owe the bank money at high rates, give that $1,000 to them first. You're not just paying a bill, you're buying back your freedom. However, if your debt is low interest like a student loan or a mortgage at 3% or 4%, then we can move forward. That's the green light to start investing. The last thing we need to fix before we hit the buy button is your mindset. Most people think investing is like a Hollywood movie, fast cars, shouting on trade floors, and getting rich overnight. In reality, successful investing is more like watching paint dry or watching grass grow. It's about discipline. It's about being okay with the fact that your $1,000 might become $950 tomorrow, but staying calm because you know it will be $5,000 in a few years. If you're looking for a get-rich-quick scheme, this isn't the channel for you. But if you're looking to build wealth that lasts, you're in the right place. So, we've checked our foundation. We've talked about the emergency fund. We've tackled the high-interest debt. And we've aligned our mindset. You're ready. In the next part, we're going to get into the meat of the strategy. I'm going to show you exactly how to split this $1,000 what we call asset allocation. We'll talk about risk, diversification, and how to make sure you're not putting all your eggs in one basket. Don't go anywhere, let's dive into how we actually divide the money. Okay, so your foundation is solid. You've got your emergency fund. Your high-interest debt is handled, and your head is in the game. Now comes the fun part. Where does the $1,000 actually go? If you're like most people, you're tempted to find that one magic stock, the next Tesla or the next Apple, put all $1,000 into it, and hope it goes to the moon. I'm going to be the buzzkill here. Don't do that. Investing isn't about hitting a home run on your first swing. It's about staying in the game long enough to win the whole season. And the secret to doing that is something called asset allocation, or, in plain English, Knowing how to split your money so one bad day doesn't wipe you out. Before we pick an investment, we have to talk about your risk tolerance. This is basically a fancy way of asking, how much money can you lose before you start panicking and selling everything? Think of it like a sleep test. If you put $1,000 into a volatile crypto coin and it drops to $600 by Tuesday morning, are you going to lose sleep? Are you going to be checking your phone every 5 minutes during dinner? If the answer is yes, you're taking on too much risk. There's no shame in being conservative. If you're young, you can usually afford to take more hits because you have decades to recover. But if you're looking to use this money into years, you need to be much more careful. The goal isn't just to make money. It's to make money at a level that doesn't ruin your mental health. In the investing world, there's a famous saying, diversification is the only free lunch. Imagine you're a farmer. If you only grow corn and a specific pest kills all the corn, you're out of business. But if you grow corn, wheat, beans, and potatoes, one bad crop won't destroy you. When you invest your $1,000, we want to spread it across different asset classes. Stocks, these are for growth. They are high energy, but they move up and down a lot. Bonds or high yield savings, these are your stabilizers. They don't grow as fast, but they don't crash as hard. Real estate REITs, a way to own a tiny piece of a shopping mall or an apartment complex without actually being a landlord. By spreading that $1,000 across these areas, you're protecting yourself from the what-ifs of the world. So, what does a $1,000 split actually look like? If you want a classic, balanced approach, you might do a 60-40th split. That's $600 in stocks for growth and for $100 in safer assets like bonds or cash. It's steady, it's reliable. It's like a reliable Toyota Camry. But if you're in your 20s or 30s and you want to be more aggressive, you might do a 90-10 split. $900 in the stock market and $100 in something safe. It's a bumpier ride, but the potential for long-term growth is much higher. The point is, there is no perfect split for everyone. There is only the perfect split for you. Now you understand why we don't bet it all on black. You understand risk, and you understand the power of spreading your bets. But talk is cheap. You're probably thinking, okay, enough with the metaphors, what do I actually click on? In part 3, we're getting tactical. I'm going to show you the specific index funds, dividend stocks, and tools you can use to turn this $1,000 into a wealth-building machine. We're going to talk about S&P 500, DCA, and why you don't need to be a genius to beat the pros. Stick around, the best is yet to come. Alright, we're in the home stretch of the strategy. You know your foundation is solid. You know how to split your risk, but now you're looking at your screen thinking, there are thousands of stocks and funds. Which button do I actually press? Most people get stuck here. It's called analysis paralysis. You're so afraid of making the wrong choice that you make no choice, and that $1,000 stays in your checking account earning 0.01% interest. Today, we're curing that. I'm going to show you 3 specific paths you can take with your first grand. The first path, and honestly, the one I recommend for 90% of people, is the S&P 500 index fund. Think of an index fund like a gift basket. Instead of buying one chocolate bar, one stock, you're buying a basket that has the 500 biggest, most successful companies in America. Apple, Amazon, Microsoft, Visa, they're all in there. If one company has a bad year, it doesn't matter, because the other 499 are carrying the load. Historically, the S&P 500 has returned about 10% a year on average over the long term. If you put your $1,000 into a fund like VU or SPY, you're essentially betting on the entire US economy. It's simple, it's cheap, and you don't have to be a genius to do it. The second path is for those who love seeing extra cash hit their account every few months. These are dividend stocks. Some companies, like Coca-Cola or McDonald's, are so established that they don't need to reinvest all their profits back into the business. So, they give a portion of that profit back to you, the shareholder. When you invest your $1,000 here, you're not just hoping the stock price goes up. You're being paid just for owning the stock. It's like owning a tiny piece of a rental property, but without the headache of a tenant calling you at 2 a.m. about a broken toilet. If you reinvest those dividends, that $1,000 starts to snowball much faster than you think. Now, here's a pro tip. You don't have to drop all $1,000 today. If the market feels scary or at an all-time high, you can use a strategy called dollar cost averaging. Instead of $1,000 at once, you could do $250 every 2 weeks for 2 months. This way, if the market goes down, you're actually buying more shares at a discount. If it goes up, your first $250 is already making money. It takes the emotion out of the game. You stop trying to time the market and you start spending time in the market. So, we've got the what index funds or dividend stocks and the how DCA. You are officially ahead of most of the population when it comes to financial literacy. But there's one final step. How do you actually open the account? What are the common traps that beginners fall into that eat away their profits? And most importantly, how do you stay consistent when the news tells you the sky is falling? In the final part of this series, we're going to walk through the action plan to get you from thinking about investing to being an investor. Don't miss the conclusion. Let's wrap this up. Alright, we've reached the final step. You've done the prep work, you've picked your strategy, and now it's time to actually pull the trigger. The difference between someone who thinks about being rich and someone who is rich usually comes down to one thing: action. You can watch financial videos all day, but your money won't grow until you put it to work. In this final part, we're going to walk through how to open your account, how to avoid common traps, and how to stay consistent for the next 10, 20, or 30 years. So, where do you actually put that $1,000? You need a brokerage account. In the US, we are lucky to have some of the best, most user-friendly tools in the world. If you want something simple and mobile first, apps like Robinhood or Webull are great for beginners. They're sleek, easy to use, and offer commission-free trades. If you want something more established with world-class research and customer support, you might look at Fidelity, Charles Schwab, or Vanguard. Most of these now allow you to buy fractional shares. This is huge. It means if a stock like Amazon costs thousands of dollars, you can still buy just $10 or $100 worth of it. You don't need to be a millionaire to own a piece of the biggest companies in the world. Now, let's talk about the stuff no one likes but everyone needs to know. Taxes. In the US, if you hold an investment for more than a year before selling it, you pay long-term capital gains tax. For most people starting out, if your income is below a certain level, around $49,000 for singles in 2026, that tax rate is actually 0%. Yes, you heard that right. The government wants to encourage you to hold long-term. Also, watch out for fees. Even a 1% management fee can eat up tens of thousands of dollars of your wealth over time. This is why we love low-cost index funds. Like we discussed in part 3, keep your costs low, keep your taxes low, and keep more of your money. Before I let you go, I want to warn you about the 3 biggest traps beginners fall into. 1. Checking your account every day. The market is like a heartbeat. It goes up and down. If you look at it every hour, you'll get emotional and make a mistake. Check it once a month, or even once a year. 2. Following the hype. If your neighbor or a random guy on TikTok tells you about a hidden gem, stock, run away. Stick to your plan. 3. Panic selling. When the market drops, and it will drop, most people sell out of fear. The pros see that as a clearance sale and buy more. Be like the pros. That's it. You have the roadmap. You have the $1,000. Now, all that's left is to start. Remember, the best time to invest was 10 years ago. The second best time is today. Your future self, the one who's retiring comfortably, the one who isn't stressed about bills, is going to look back at this moment and thank you for taking this first step. If you found this series helpful, hit that like button and subscribe. We're building wealth together, one step at a time. Thanks for watching, and I'll see you in the next one.